Welcome back to another edition of Special Situations Investing with Greg. This week I'm talking about a liquidation, Safeguard Scientifics Incorporated. Check it out. Hey everyone, welcome back to another edition of my YouTube channel on Special Situations Investing and my personal investing practice. As a quick disclaimer, this video is for educational purposes only. Any companies that I mention in this presentation are discussed solely for illustrative purposes. Discussing such companies and the specifics about them is to help educate me and educate you about certain special situations. It is not a solicitation to purchase them. I recommend that you conduct your own research and identify why you might want to own the company yourself prior to your committing of any funds. I also recommend that you seek the services of a financial advisor that has considered your personal situation as your fiduciary. And then finally, may your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks a bunch for watching. Now on to the video. Welcome back, Investing Mutants. This week, as I said, we're talking about Safeguard Scientific Incorporated. This is a company that has been a long-term special situation that looks like it's a liquidation that might actually finish up over the past couple of years. It looks like they've been doing everything they can in order to find an exit strategy for the company. I'll go over what I think about it and some places where you could do additional study, and hopefully this turns out to be something that you are interested in. In full disclosure, I did participate in the tender offer that is currently going on with this special situation. I didn't get in at probably where I would like to be, but I am still participating in it as part of their tender offer. So, first and foremost, let's start off with the tender offer so you can understand what's going on with that. So there's a Dutch tender offer for Safeguard Scientific shares. They are doing this because they completed a sale of one of their businesses. Basically what Safeguard Scientific has done is they have done a lot of the initial funding for a lot of private equity type deals. And all of the companies that they invest in are revenue, at least companies where they've achieved a significant amount of revenues. And they take this and then they sell off the company as they are completing. They have not generated income or revenue themselves for something since like 2009, and so the company itself is not necessarily something that I would consider necessarily investable for the long term, but as part of their liquidation, it definitely something that you might find interesting. This Dutch tender offer that they're doing is for shares between $7.90 and $9 per share, and it is for up to 18.7 if you do the high end, or 21.3% of the total shares outstanding. The company is making this tender offer because they sold off one of their businesses, their interests in one of their businesses, Flashtalking. Flashtalking was a social media, digital media type company that they were helping get out of that final phase of funding, and they sold it off this last year for $43 million, or about $44 million. They've taken $35 million of that, and they decided to repurchase shares with that, and that's what will come up with this. I think that it's interesting because I think Flashtalking is actually quite, they got a pretty good deal for it. So, in my view, overall, the Safeguard Scientific is kind of, this is a difficult business to be in because minority interest venture capital doesn't necessarily keep you at the forefront, and so that's essentially what they have. They have minority interests in all the businesses that they own. They do have board seats, and they do have enough capital that they should be able to maintain senior position, or at least equal position on where they are. But they have a significant amount of money that they have to hold up as part of that. Now, they do have also a lot of losses that they can take against all of the sales of all the businesses, and so Most of the funding that comes from each of the sales should come back almost dollar for dollar into the liquidation assets. So because they have so much of this debt that is out there, you should not have to spend, you should be able to say, okay, they sold this next business for 10 million. Well, we're going to get about 9.8 million to go into the company's coffers or repay shareholders. In full disclosure, like I said earlier, I have participated in the tender offer for this. I got in with my position at about $8.44 per share. I don't know if I'm really seeing the tender offer as the opportunity here, but the liquidation over the next couple of years is the real opportunity. Now, if you believe management, they assess or they believe that their companies should earn somewhere around $6 or 6 times the current revenue streams on all the companies that they own. And if that were the case, you should expect to get over the next 2 to 3 years $232 million for the final companies that are out there. Now, when you're in a liquidation status, and in particular this liquidation, I don't know if you should expect to get the same amount for all of them. And so 6 times revenue, you might get more, you might get less. It might be a good time to sell some of their properties. Who knows? However, if they were able to do that, that would represent about a 33% price increase over the $9 per share high-end price of this tender offer. Now, I don't have a clue how to value this company, and I don't know if management really has a clue how to do it. In fact, I would be skeptical of anybody who says, hey, I know exactly how much this company is worth, unless they've done some Michael Burry type stuff and they've dug into every single specific company and did everything like that. Maybe someone like Michael Burry would get into something like this, but who knows? It would be a lot for the returns that you might get out of this. It may not be as lucrative as some people might say. I recommend that if you are an interested investor in this, that you spend some time looking at, Dayton Investing's article on Seeking Alpha, and more importantly, that you dig into the comments below, because it looks like there's quite a few special situations investors that have weighed in on this one, and they're all kind of looking at this as a potential good play for anybody who might be interested, and you can kind of see the thoughts that are going into this. As I said earlier, SFE, or Safeguard Scientifics, they are repurchasing these shares with the proceeds from their Flashtalking sale. Now, prior to the sale, Flashtalking represented about 13.3% of their total portfolio value. If they're able to repurchase the shares, even at the high end of this tender offer, then that would represent about 18%, almost actually 18.7% of their shares outstanding. So almost 19% of the shares for only 13% of the portfolio. In my view, that's a pretty good deal, and I did the numbers on this, and it looks like it's a 41% excess that they're getting out of repurchasing shares as a result of this tender offer. So if they could repurchase the shares at a lower price and then continue to get decent pricing for the company, the thought is that they should be able to continue to execute and pay back shareholders if you're willing to stick with them over the next 2 to 3 years. This brings me to Eric Saltzman. Eric Saltzman is the executive officer that is in charge of this reorganization department for them, and if he's able to do this type of deal on every single one of the investments from here on out, you should expect something about $20 per share for the company over the next 3 years. So definitely something that could be worthwhile for anyone that might be interested in investing in it. I dug into the numbers and I decided to analyze the portfolio a little bit more. I cannot say that I have any clue how much it is. I'm going to reiterate that. However, I did dig into the numbers, and I did a 4.5 times revenues for all of them, and then averaged the amounts between their their high end and low end of each of their portfolios. So they don't actually give you the specific revenue numbers for each of them in their investor presentation. So I averaged the high end, low end, and diluted and non-diluted amounts to get this number. And so this number is just kind of giving me a ballpark figure of what I should expect for it. So if they're able to do 4.5 times revenues for all of the companies in the business, which I think is kind of a reasonable perspective for this, you should expect somewhere between around $14.75 per share, and that's given that your interests are not diluted. If they're able to buy back a bunch of shares, this would definitely be able to make sure that you are going to continue to keep that. As I was preparing for this video, I realized that I had not spent too much time talking about liquidations, and I think it's good to pause for a second and think a little bit about some of the things that you should think about with liquidations. And one of the things to pay attention to with liquidations is that timing can be a huge issue, and these risks, of all the risks for liquidations, I think timing is probably the most important. And part of the reason why SFE has not had shareholders stick around with them a lot is because their timing has been definitely off with prior executive officers. On the timing note, there's a couple of things to think about. First and foremost, you have Flashpoint. You have this special situation that's occurring right now where you're getting paid back your cash for the Flashpoint investment. And then you go ahead and MediaMath, it looks like it's the next one on their docket. MediaMath represents about 13% of their overall portfolio as well. And so between these two, if they can go ahead and repurchase 20% each time, you could definitely see the rest of the portfolio coming back to any investor that sticks along with them, of having a significant amount of their equity interests maintained with the company, and maybe even going up bigger. I could definitely see MediaMath is one of the bigger ones revenue-wise, and so they're starting to get into some of the smaller companies overall. Eric Salzman, Mr. Salzman, is he has a lot of experience with mergers and acquisitions, according to his bio. I don't know too much about him individually, but you're kind of betting on his perspective with this, and if his experience with Flashtalking was any indication, it shows that he's going to go ahead and do quite well. On the flip side, BHG, which is one of their healthcare companies, they went and they took it, they sent it out on an IPO, and since the time that it was IPO'd to the time that looks like it's about the time that they can actually get out of the lockout, then the company is, or the share price for BHG is actually halved almost. It's close to around $10 a share when it was IPO'd at about 17. So this one, if they end up having to explore options like going out into the IPO market, they may not be able to get the type of funding that they would like out of these companies post the lockup period. Another risk with participating in SFE after this tender offer is that you have to realize that SFE had a significant drawdown in their value based on what happened during COVID. A lot of their companies lost their revenue streams or lowered revenue streams due to the COVID downturn. Now, I think over the long term it'd probably be all right, but again, this is a liquidation. It goes back to timing. You may or may not find that it's useful, and you may not want to lock up your money in this. And that's the whole reason why someone wouldn't necessarily want to participate in a liquidation. It's also the whole reason why a liquidation can sometimes turn out to be lucrative for the individual that participates in it. I've participated in only a couple other liquidations, but this one does continue to remain interesting to me. One final note, when we talk about the SFE tender offer, is that kind of establishes a baseline of what the management team is willing to pay for the remaining assets of the company, and that's kind of in line of about a 4.5 multiple of revenue. And so that should give you, I think it's actually closer to about 4.425, but 4.25 times your revenue, that kind of gives you an idea of what it is. Management continues to insist that it's about 6 times revenue. That may or may not be the case, but I think it does provide the upside potential for this. In summary, I think the company is trading at a fair price. Number 2, I think that the potential upside, most likely upside, is going to be somewhere around $12.50 a share for this company, which represents about a 30 to 40% upside for where you might be looking at it. The third thing that I looked at is when I ran the numbers, I also did a 3 times multiples earnings or revenues for the company in the valuation, and that would put you somewhere around $5.25, 26 cents per share. So the way I look at it is I'm risking about $3.20 for the potential of, or the likely return of about $4.20 per share, and the flip side is there's a potential to go up higher with that, and that is up into that $20 per share range, and that would be closer to about $11.20 additional per share for the company. I hope you guys find this interesting. If you are participating in the SFE liquidation or tender offer, let me know in the comments below. Let me know if you find that this is a useful setup, and hopefully it turns out well for us over the next couple of years with this one. Thanks a bunch for watching, guys, and we'll catch you next week.